Okay, so we're going to be looking at the 2021 Sole Trader final account here. As you know, in 2021, because of COVID-19, you were offered the choice of answering either one of two final accounts questions. So a sole trader came up and a manufacturing account came up. And so we're going to be looking at the sole trader here, Kenny. So as I say, there are 6 different steps that I would like you to take to answer this in order to maximise your marks and minimise your mistakes. So first of all, I would say for you to lay out your accounts, that should take 5 or 6 minutes. Then I would say transfer your figures into your accounts from the trial balance, should take 6 or 7 minutes. Then we would have step 3, calculate the investment income and the debenture interest for the year, and that should take 3 or 4. Now at this point, all you will have looked at in the question is the trial balance. The only time you would have taken out your calculator was to calculate the investment income and debenture interest for the year. At this point as well, you've probably secured yourself somewhere between 30 and 40 marks just up to that point. So that's a really good foundation in which to start. Next, then, you've got to complete your adjustments. So I'd say you've got approximately 32 minutes to do this. But if you practice everything that I'm giving you, I think you probably can do it in shorter time than that, okay? Lastly, then, you tot up your total. So there's 5 minutes there. And I'll show you the important things that you'll need to do there. Okay, so step 1, you lay out your accounts. So you can pause the video and write it out, or you can test yourself, see can you do it without looking, and then come back. So that is step 1, should take you 5 or 6 minutes. Step 2 is to transfer all your figures into your accounts from the trial balance. So every single figure in the trial balance should be entered into the trading profit and loss or balance sheet somewhere. Okay, you need to remember, all right, that the items on the debit side are assets and expenses, with a couple of exceptions to the rule. You've got drawings is the opposite of capital, so capital is always credited, drawings is debited. And then you have debtors. You have debtors here, but bad debts provision is a contra asset, so it's just reducing the asset debtors there. So that's just a couple of exceptions to that rule. So credit side, you have your liabilities and revenues. Okay, so you can pause the video now and attempt to put everything in where you think it belongs. Okay, but if you don't, this is where everything will go, and then I'll show you how I entered it into the accounts. Okay, so again, you want to pause, feel free. Okay, so that is everything. That is step 2, fully completed when you've got your figures from the trial balance into your accounts. Then we've got step 3, which is calculate the investment income and the debenture interest for the year. And then we'll put the amounts due into the balance sheet as well. So investment income due will go in current assets in the balance sheet, and mortgage interest due will go into creditors minus 1 year. So you can see from the trial balance how much your investments are and how long you have them for. So you have them on the 1st of the 8th. Okay, so therefore you have 210,000 by 3% multiplied by 5 over 12 months that they had them for. So that is 2625. You have to be very careful about the dates here. And then your mortgage interest is 230,000 by 5% by 3 over 12, because you had an increase in the mortgage, okay, after the 31st of the 3rd. So up to the 31st of the 3rd, you had 230,000, all right? So 230,000 by 5% multiplied by 3 over 12, and then you add 280,000 by 5% by the remainder of the year, which is 9 over 12, so that is 10,500. So altogether there, that is 13,375 euro. Okay, so you slotted them in. So investment income for the year then 2625, mortgage interest for the year 13,375. Now I'm not going to put this over here because sole trader final accounts, a lot of the time they live in part of the house, so some of the mortgage interest is attributable to drawings, so we have to split it up. But it'd be fine if you put it here, you just have to scribble it out and then fix it. Then you've got your investment income due, so this is the amount for the year minus what it said that it had paid in the trial balance, and then mortgage interest due. This is for the year minus what they said they had paid in the trial balance. Sorry, this is what they had received in the trial balance. Okay, so that's step 3 complete. And as I said, you've got about 30 to 40 marks secured now at this stage. Next, we'll move on to our adjustments. Now, first adjustment, I would just take it adjustment by adjustment. You can give it a quick look as you're going along, or sorry, at the start, but I really would just start at the top and then work your way down. Okay, when you practice all of these, and you will have notes and videos on all these different types of adjustments. When you practice all of these, you'll be really good at them, and some adjustments might only take you like a minute to do. So if you've got 8 adjustments here, you're definitely going to get it done in the 32 minutes. Okay, so we'll just get started. So the following information and instructions are to be taken into account. So stock at cost on the 31st of the 12th, 2020 was 72,100. This includes damaged stock, which cost 12,400, but which now has a net realisable value of 25% of cost. So look, the stock isn't unusable. It is, we can definitely sell it. It's just that the value of it, has reduced. So all we need to do is show the reduction in value of it, okay? So in the trading profit and loss, you'll just say closing stock 72,100 minus 12,400 plus 300 there. And then in the balance sheet, you'll have your closing stock as per TPL, and then whatever the figure you have here, you'll then just transfer it down over here. If you get the figure in the balance sheet here completely wrong, you will still get the marks for it based on your own incorrect figure. So happy days. Whatever you write here in the trading account, just write here and you'll get your own marks for it. That's what I've seen happening every time I've corrected. Okay, so note 2 then. Note 2 there is goods that were sent to a customer on a sale or return basis on the 31st of the 12th, 2020. These goods were recorded in the books as a credit sale of €28,000, which is a markup on cost of 25%. Okay, so here students do really awful at this, but it's actually quite simple when you understand what a sale or return is. So what is sale or return? So this is basically an agreement between the seller and buyer that states that goods that are not sold will be taken back without having to be paid for. So in these adjustments, the business's bookkeeper enters the sale or return agreement at the end of the year, so 31st to 12th, as a credit sale or credit purchase by mistake, and now it's just your job to fix it. So in this adjustment, we will see it was goods sent to a customer and it was a credit sale, so we have to rewind the credit sale. So what the bookkeeper did by mistake was they did closing stock minus cost price, and then sales plus cost, selling price, and then debtors plus selling price. So I'll just say that again. What the bookkeeper did by mistake was they took the cost price of the goods from closing stock and they added the selling price to sales and they added the selling price to debtors. So what we're going to do now is we're going to take away the selling price from sales, we're going to take away the selling price from debtors, and we're going to add the cost price back to closing stock. How did I get the 22,400? Well, I got 28,000, which is a markup on cost of 25, so that's 125%. So 28,000 divided by 125 multiplied by 100, and that is 22,400 that we added there. And again, here we've nothing to do here apart from write down whatever the final figure is from the trading account. So that's an adjustment done. If you understand that and you practice it and you know exactly what to do, that there will only take you a minute or so. Okay, so this one here, there is a lot to this adjustment. Okay, so there's a good bit going on, but it can sometimes get to up to like 20 marks out of the 120. It appears in every single sole trader and company final account question, so it's really worth putting the time in to practice it and get it right, okay? And again, it'll appear in all of section 2. You'll see loads about depreciation there as well, so it's worth it. So there's going to be 5 things that we're going to have to do here, okay? We will, in the trading profit and loss, we'll have to fix the purchases figure. We will calculate the depreciation charge on delivery vans for the year. We'll calculate the profit or loss made in the sale of the old van. And in the balance sheet, we'll calculate the cost of delivery vans at the end of the year. And we will calculate the accumulated depreciation on all delivery vans held at the end of the year. Okay, look, let's read through it here. It's very similar to ones that come up all the time. Something slightly different came up in a company account in 2019, which we will be looking at as well. Okay, right, so reading through this one here. Provide for depreciation on delivery vans at the annual rate of 20% of cost from the date of purchase to the date of sale. Note, on the 31st of the 3rd, 2020, a delivery van which had cost 42,000 on the 30th of the 9th, 2016, was traded in against a new van which cost €67,000. An allowance of €11,000 was given on the old van. The cheque for the net amount of this transaction was entered in the bank account but was incorrectly treated as a purchase of trading stock. These were the only entries made in the books in respect of this transaction. Okay, so basically word for word for about, 10 other years that this has come up like this. Okay, so first of all then, you just imagine in your head the van on the left here. The sole trader is driving in an old van, okay, and Ford or whoever they're going to is giving them an allowance of 11,000 for that old van. The sole trader wants to drive away in this new van today, okay, so the sole trader has to pay the difference in the 11,000 and then the cost of this new van. Now this new van up here, you see it's 67,000. So we have a few things to do. We have to record the sale of this old van, work out did we have a profit or loss. We're going to have to fix the purchases figure because it says that the cheque for the net amount of this transaction was entered in the bank account but was incorrectly treated as a purchase of trading stock. So van is not a purchase of trading stock. That's what they're telling us here. We'll actually just get started and we'll fix the purchases first. Okay, so the bookkeeper accidentally recorded the cheque that the owner gave to Ford or the car dealership or whoever it is as a purchase of trading stock. Okay, so obviously we know then that the business doesn't sell vans. That's not what they're in the business of doing. If they did sell vans, the purchase of this van being treated as purchases would be completely fine. Okay, the fact that they treat it as purchases instead of motor van is an error of principle. Okay, so we need to fix this anyway. It was the cheque for the net amount of this transaction entered in the bank account correctly but was incorrectly treated as a purchase of trading stock. So how much was the cheque for? Well, it was the cost of the new van, which was 67,000, which I told you a minute ago, minus the trade-in allowance for the old van, which was 11,000. So 67 minus 11 is 56,000. So I need to take 56,000 out from purchases, and that fixes my purchases account. Next, what we'll do, we'll pop over then to the balance sheet and we'll work out the cost of vans. And the reason why I'm doing this is because this will then help me to calculate the depreciation charge for the year, because I'm going to need to know the cost of the delivery vans after the trade-in before I can do the depreciation charge for the year. Okay, so the cost of vans. The old van cost 42, so we've gotten rid of that, so we'll have to minus that. And then the new van cost 67, so we're going to add that. So up in the balance sheet, the first bracket here is my cost. So I will say from my 380 that I had in the trial balance, 380 minus 42 plus 67, and that is €405,000 is the cost there. So that's the second thing done. Next, we will work out the depreciation charge for the year. So we have to pay particular attention to when was the trade-in, when did it happen? So it happened after the third month. So for the first 3 months we had 380,000 worth of vans, and then after the third 3 months at the start we had 405 for the last 9 months. Okay, so it's important to know because you're told that we have to provide for depreciation on delivery vans at the annual rate of 20% of cost from date of purchase to date of sale. So you've got your 380 by 20% by 3 over 12 months, and that's 19,000. And then you add that to your cost of vans for the last 9 months by 20% by 9 over 12, and that is 60,750. So the depreciation here, 79,750. Now that's going to go up here in a second, but we'll get to that now in a minute. Now, profit or loss on the sale of van is our next thing that we have to do. A profit would go into add operating income here, and a loss would go into selling and distribution. Because why is it a selling and distribution? Because distribution, delivery vans, it's all about distributing the goods to your customers. So that's why we put that on depreciation there. So the sole trader charges depreciation every year, 20% of cost. So we have to work out, did the sole trader value the old van lower or higher than the trade-in allowance that the Ford dealership gave them, which in this case was 11,000. So obviously if the sole trader valued the van higher than 11,000, it's going to be recorded as a loss in selling distribution. And if they recorded it lower than 11,000, it would be profit on sale of delivery van. So this is probably where students make the biggest mistake, right? So we need to be very careful here. Now, what we need to do is be aware that the old van was bought on the 30th of the 9th, 2016, and it was sold on the 31st of the 3rd, 2020. So we need to work out how long did they have this old van for. So I really want you to write this out. So over here on the right hand side of the screen, 2016 they had it for 3 months, 2017 they had it for 12 months, 2018 they had it for 12 months, 2019 they had it for 12 months, and then 2020 they had it for 3 months of 2020. So overall that is 42 months or 3.5 years. So anyway, now we'll do it using our formula. The cost of the old van minus accumulated depreciation is what it was worth at the time of sale, net book value. We'll compare it to the allowance, and that'll tell us whether we made a profit or a loss. So the cost of the old van was 42,000. The accumulated depreciation, 42,000 by 20% by 42 over 12 months, that's the length of time we had it for, was 29,400. So therefore, at the time of sale, the sole trader valued the van at 12,600. Unfortunately, they only got 11,000 for it, so that means that they made a loss on sale of 1,600. Okay, so therefore that is going to go into the selling and distribution expenses there. So we've got one last thing to do. All right, and that is to work out the accumulated depreciation in the balance sheet. So we want to work out, based on these 405,000 worth of vans here, how much have they depreciated since the sole trader has had them? Okay, so well, there's going to be the 70,000, right? The 70,000 that they had originally from the trial balance. And then we'll take away the accumulated depreciation on the old sold van. So there's no need to record that depreciation when we no longer own that asset. And then we will add the depreciation for the current year. So that is in total 120,350. Now I want you to note that we've got 3 figures in the cost bracket and 3 figures in the accumulated depreciation bracket. So you need to have 3 and 3 if they have sold a van and they have bought a van. Okay, so that's really important to know that. Okay, right, so moving on then to the next adjustment, adjustment number 4. So during 2020, a storeroom which cost €75,000 and stock which cost €24,000 were destroyed by fire. The insurance company has agreed to contribute €90,000 in compensation for the fire damage. No entry had been made in the books in respect of the fire. A new storeroom was built by the business's own employees. The cost of their labour, €44,000, had been treated as a business expense, and the materials costing €38,000 were taken from existing stock. No entry had been made in the books in respect of the new storeroom. Okay, so this is brand new to sole trader final accounts. It hadn't appeared here before. Now, it is common in company and in manufacturing accounts. Now, there's a couple of things we have to do here. We'll take it kind of paragraph by paragraph here. So the first thing we have to do is we have to account for the fire and the insurance claims. So we need to record them. So during 2020, a storeroom which had cost 75,000 and stock which cost 24,000 were destroyed by fire. What we're simply going to do here is subtract 75,000 from your buildings and subtract 24,000 from purchases, as both of these accounts lost value during the fire. Now, tons and tons and tons of students here in the summer, when I'm correcting it, they always reduce the closing stock by 24,000. But I need you to know that if you see during 2020 or during the year and the word stock in the same sentence, that is always just the purchases account. Okay, 31st of the 12th, that's grand, that's closing stock, but during the year, that's just purchases. Okay, so that's the first sentence there. Next, then we look at the insurance company has agreed to contribute 90,000 in compensation for the fire damage. No entry had been made in the books in respect to this fire. Okay, so what we need to do here is we have to say to ourselves, well, have we received this from the insurance company? The answer is no. Okay, they've agreed to pay us 90,000 in compensation, but that has not been received yet. Therefore, we're going to put that into insurance claim due in the current assets. So the insurance company owes that to us, right? That's 90,000. Now, very important that we think about, well, how much was the loss? So the loss was 75,000 and 24,000. So that's 99,000 damage. Okay. So the insurance company aren't covering all the damage. So therefore, you're going to have a loss on insurance claim of 9,000, which is going to go into the administration expenses. Okay. So that is the first paragraph done there. Next, we'll go to the second paragraph. A new storeroom was built by the business's own employees. The cost of their labour, 44,000, had been treated as a business expense, and the materials costing 38,000 were taken from existing stock. No entry had been made in the books in respect to this new storeroom. Okay, so before we get started on this, I need to make sure that you have this drilled into your heads. Okay, so the trading profit and loss account here, okay, records expenses and revenues of the business for the current year, and it helps us say, did the business make a profit or did it make a loss from conducting all of its business affairs, whatever, okay? So no assets or liabilities go in here. Where do assets and liabilities go? They go in the balance sheet. So they record all the assets and expenses. So the building that was just rebuilt, so the cost of rebuilding that needs to go into the balance sheet, okay? So how much goes into the balance sheet? The balance sheet needs to be increased by the total cost. So the labour, 44,000, and the materials, 38,000. Now, the labour had been treated as a business expense. It's not a business expense because it doesn't tell us, profit or loss on the sale of the company's goods. That's not what this is. This is, we're making an asset, okay? So we need to take the costs from the trading profit and loss. They should not go in there. They are not an expense of the business to work out whether they made a profit or loss. They are the building of an asset. So therefore we add those over in the balance sheet. And that's it. That's all you need to know to remember to do. Okay? Now, so at that moment in time now, if you totted all this up, your buildings would be worth 907. So 900,000 minus 75 loss on fire, plus 44,000 for the salaries and making the new building, and then plus 38 the materials. So 907 is what that is. Now, next note 5. Buildings are to be depreciated at the rate of 2% of cost per annum. Land at cost was 400,000. It was decided to revalue the land and buildings at 1.1 million on the 31st of the 12th, 2020. So this judgment is asking for us to depreciate the buildings at 2% of cost per annum. So as I just said, the buildings now have a cost of 907. Okay, now it does say landed cost was 400,000, so we do not depreciate land. Okay, so we do not depreciate land. So therefore, our depreciation on our buildings is going to be 907,000 minus 400,000 and multiply that by 2%, and that is 10,140 euro there. Okay, in administration expenses. Then I add that up to my accumulated depreciation up here in the balance sheet. So that is the first sentence done. The second sentence states that it was decided to revalue the land and buildings at 1.1 million at the end of the year, 31st of 12. So therefore, up in the cost here, I've got 1.1 million. I've got 0 in my accumulated depreciation, and I've got 1.1 million in my net book value because it was revalued at the end of the year. There's no depreciation here. Now, when a building is revalued, we have to create a revaluation reserve down in our finance buy. So it's not a profit that the company has made, because it's not a profit until they've actually, sold the property and actually got the cash money for it, okay? But we have to show that there is value somewhere. And this increase in value, the shareholders own that, right? So that is in capital and reserves then. So 193 is the difference between 907, the cost of the buildings, and the new value, 1.1 million. So that is 193,000. Then we're simply adding back in any depreciation that had taken place on this, so the 105 and the 10,140. So when it's revalued at the end of the year, there's going to be 3 figures in here as well. So that's 308,140. Okay, next adjustment then is the suspense adjustment, all right? So the suspense figure arises as a result of the incorrect figure for mortgage interest, although the correct entry had been made in the bank account and a payment of 2,900 to creditors entered only in the bank account. Okay, so basically I have corrected for years, obviously, and I have said that I have seen in the past students taking up a whole page in the notes to correct this. So the way I'm going to teach it to you is to do it in the quickest possible way and to just try and get the least amount of errors. Okay, so we'll practice tons of these anyway, so you won't have to worry too much. So remember, just assets and expenses go on the debit side and liabilities and revenues go on the credit side. Now, this trial balance didn't equal at one point, right? So what the bookkeeper did was they shoved in a figure into the advertising account, and then eventually the balance down there. So that's great. Right, so let's take the first half of this then, right? So the incorrect figure for mortgage interest, all right? Correct figure had been put into the bank account. So this mortgage interest paid for the first 3 months is incorrect. So if we worked out what the first 3 months mortgage interest should be, it would be 280 minus the 50 top up, because the 50,000 top up was issued on the 31st of the 3rd. Okay, so therefore my mortgage for the first 3 months of the year was 230,000. 230,000 multiplied by 5% by 3 over 12 is 2875. So this here should be 2875. What I'm going to do is I'm going to add 500 euro to that to make that 2875. However, when I add 500 euro to the debit side, I'm out of kilter now. I don't equal, okay? So what I'm going to have to do then is go up to my figure with the suspense, and I'm going to have to do whatever I need to do to make these equal again. So hopefully you'll know if you plussed 500 on the debit side, you're going to have to minus 500 on the debit side then to get these to equal. So that's the first part of it. Second part of it says a payment of 2,900 to creditors entered only in the bank account. Okay, so here's my creditors figure here. My creditor, as you know, is a liability. They are the people that we owe money to. So if I made a payment to them that is going to reduce the 68,600 by 2,900. So I'll minus 2,900 there. Now, as you know, your debits and credits must equal. So that means that my debits and credits there, they don't equal. Okay, so I'm 2,900 down on the credit side. So what I have to do, I have to go back up to my item incorporating suspense, and I have to do something there to that to make both sides equal. So this is on the debit side. If I minus 2,900 from something on the credit side, I must always minus 2,900 for something on the debit side. So that is that. All we have to do then is pop those things into our accounts. So your advertising, we've got 36,000 minus 500 minus 29. We've got our mortgage interest due, so we had 2375. Sorry, it doesn't really look like it there, but we had 2375. We'll cross that out and we'll minus 2875 because that's the correct figure. And then we will have our creditors minus 29. So that's our suspense account. Now, next account we have is our bank account. Now, bank adjustment, like, it's fairly long looking, really intimidating looking, but it's really not when you practice a few of them. And we'll be practicing loads of them together, so you'll be fine. So we're going to practice it in a way that you should never get the bank figure ever wrong again. Okay, so it only ever came up in company and manufacturing accounts until 2020 when it appeared for the first time in the sole trader final account. So they're really nice adjustments, and when you practice them loads, you'll be well able. So this adjustment, the figure for bank in the trial balance, has been taken from the business bank account. However, a bank statement dated the 31st of the 12th, 2020 has arrived showing an overdraft of 29,200. A comparison of the bank account and the bank statement revealed the following discrepancies. Number 1. A credit transfer of 1,800 had been received on the 31st of the 12th, 2020 in respect of a debt of 2,500 previously written off as bad. The debtor has agreed to pay the remainder within 2 months. No entry was made in the books to record this transaction. Number 2. A cheque for 18,700 issued to a supplier had been entered in the books, cash book and ledger as 17,800. Number 3. A cheque for 4,800 issued to a supplier had been returned. This had not been entered in the books. Number 4. A cheque for advertising 17,200 has not been presented for payment. Okay, so we need to get started. So just a couple of visuals there to get you thinking. So the bookkeeper's bank figure and the bank statement bank figure doesn't equal at the point in time, but we need to get to the point where they do equal. Okay, so sometimes the bookkeeper knows about things that the bank doesn't know about. So an example could be a cheque that's been issued to a creditor, but the creditor hasn't presented it to the bank yet, so they still have it in a drawer or a wallet somewhere and they've yet to lodge it to their account. Another example could be if the bookkeeper made a mistake in her own books, right? So the bank will never know about that, and nor, like, they won't care at all, right? So that's an example there of what a bookkeeper would know about that a bank wouldn't. What would a bank know about that the bookkeeper mightn't know about as yet? So sometimes the bank knows about things that the bookkeeper doesn't know about yet. So, for example, if a payment from a debtor was paid straight into the bank without informing the bookkeeper that they were doing so, the bank would know about that first. Another example could be a direct debit for electricity or something. It's left the bank a day or two earlier than planned or something like that. So the bank knows about those type of things first, or they know about dishonoured checks. If the bookkeeper lodged checks and it was dishonoured because the other person had no money in their account or something like that, that's another example. So we need to get to the point where the two sides equal. Okay, so the bookkeeper and the bank statements figures both equal. So in this question, the bookkeeper's bank figure is 52,100 and that's an overdraft, and then AIB has an overdraft there of 29,200. So getting started then, we need these two, quite a difference, we need these to equal out. So let's get started with the first one. So a credit transfer for 1,800 had been received on the 31st of 12th, 2020 in respect of a debt of 2,500 previously written off as bad. The debtor has agreed to pay the remainder within 2 months. No entry was made in the books to record this transaction. Okay, so it was paid directly into the bank. Okay, so the bank or AIB knew about this, so the bookkeeper didn't know about this. Okay, so how much was it? It was 1,800 that came in. Okay, so that would reduce the bookkeeper's bank figure, the overdraft, by 1,800. Now we need to look at what other accounts are affected here. So basically, we've received 1,800 from a debtor who was previously written off as bad. They want to do business with us again. So that is going to be, bad debt recovered. Now they've promised to pay us the remainder, which is 700. So the debtor account is going to be, that should be down here, but sorry, the debtor account is going to be increased by 700 because they've promised that they're going to pay us the remainder. The bad debt recovered is going to be increased, like it's going to 2,500. It's going to have to be recorded in the trading profit and loss under add operating income, and then that's that number one done. Number two then is a cheque for 18,700 issued to a supplier had been entered in the books, the cash book and the ledger as 17,800. So that is a mistake that the bookkeeper has made. Okay, so what the bookkeeper should have done is it should have minus the bank account 18,700 and then minus the creditor, because they sent a creditor a cheque. What happened by mistake is that they recorded it as 17,800. Okay, and then how do we fix that then? So we fix that as 900 on the credit side of the bank and then 900 on the debit side of the creditor. So that will fix it. That will get us up to our 18,700. So the bank, we're going to minus 900. So that's going to go further into overdraft. And the creditor, we need to take 900 away from the creditor. So it's not going to affect the bank. Okay. The 900 is going to increase the overdraft. So that's why we plus, because this is an overdraft. And then the creditor, we are going to minus 900 there as well. Then we have number three, a cheque for 4,800 issued to a supplier had been returned. This had not been entered in the books. Okay, so it hadn't been entered in the bookkeeper's books, so nothing would happen the bank. Now, cheque for 4,800 issued to a supplier being returned, that could just be returned in the post or something. Okay, so we've just received the cheque back into the business. So what we're going to do is we will put it on the debit side of the bank account, which would decrease the overdraft. Okay, so that's the asset increase, and so it's going to decrease the overdraft, 4,800 here, and then we're going to add 4,800 to the creditor because we now owe them that again. So we're going to have to try and send them the cheque again. Then lastly, we've got number four. We have a cheque for advertising, 17,200 has not been presented for payment. So we sent a cheque to an advertising company for 17,200 and basically they just haven't gone into the bank and given it to the bank yet. So when they do, okay, basically what's going to happen, this AIB bank figure, the overdraft is going to increase. Now, the bookkeeper knew about this cheque because she would have given it to the advertising company. So it doesn't say that the bookkeeper hasn't done anything in her account, so we can cross that off there. We've nothing to do there. But the overdraft, AIB's bank statement figure, will increase by 17,200 there. So overall then, you've got €46,400 in overdraft. And that is it. So how is this going to look in the books then? So you've got your bank figure here. You're going to minus 18 plus 900 minus 48. That's 46,400 there. Then you've got debtors plus 700. Bad debt recovered in the add operating income, 2,500. And then you've got your creditors plus 900 and minus 4,800. Sorry, that should say plus 4,800. Sorry, I said it wrong. It is plus 4,800. Okay, last thing to do then. Provision should be made for the following: investment income due and mortgage interest due. Note, 20% of mortgage interest for the year refers to the private section of the building. Okay, so we're lucky we've got our investment income due and our mortgage interest due kind of already done, so we just need to top those in there. Okay, so you have 425 investment income due and mortgage interest due 10,500. Now, you're told that you're going to have to split the mortgage interest 13,375, 80% into the business and 20% into drawings. So that's quite easy there. 80 and then 20 in here. And 20% is 2625. So 20% of 13,375, 2625. So that's the first part. Next part, provision for bad debts to be adjusted to 6% of debtors. Okay, so provision for bad debts is just we don't think that we're going to get payment from them. So you have to account for this in the balance sheet. So your debtors figure, you have to do it in your new debtors figure. So 70,000 there. Now you think you're not going to get 6% of that. So 70,000 by 6% is 4200. Now it originally was 3500 from the trial balance. So we have to compare that. That has gone up €700. So that is an increase in bad debts provision, which will go in selling and distribution because you sell to your debtors and bad debts provision is related to your debtors. So that is it. That is all your adjustments done. Last thing you have to do then is tot up your totals like such. And it's very important for you guys to know you really need, if you run out of time or anything, first thing you should do is tot these up because there could be a penalty of 2 marks. So that is the 2021 question 1 a sole trader final account complete there.